Good morning, everybody, and welcome to another of our enterprise webinars. And this morning we'll be talking about getting ahead with your year-end tax planning. Lots of familiar names again on the delegate list, and a lot of interest in this morning's webinar, I guess, after all having just probably filed your last year's tax returns, you're already thinking about the tax planning for the current year. So, like I say, lots of familiar names on the delegate list, but for those of you who don't know us quite so well, and we are a top 10 audit, tax and advisory firm, and we work with businesses across all different sectors, including not-for-profit and, of course, private client. We're also part of an international network with presence in over 100 countries. And we were also one of the first accountancy firms to have our own legal practice. And we've also recently acquired law firm SGD. So we now have a much more expanded legal offering, and more SGD, which is the combined entity, includes family law and private client specialists as well. So today we'll be talking about year-end tax planning. Tax rules and regulations don't stand still for more than 5 minutes, it seems, and are becoming ever more complicated over the years. So it really is crucial to get ahead with your tax planning rather than leaving it to the last minute and thinking at the end of March, oh, I've got 5 days left to get it all sorted. And if you delay it, it really means you're not going to have time to properly optimise the planning and to optimise your position for the new tax year and therefore reduce your tax liabilities. So in order to talk about all of this today, I am delighted to be joined by David Mitchell.
Hello.
He's a director. Hi, David. He's a director and chartered financial planner and part of Moore Kingston Smith Financial Advisors. David specialises in advising entrepreneurs, company executives and investors on their retirement planning and investment and protection needs. And his holistic approach enables him to tailor financial solutions that reflect each client's priorities and their various aspirations. And we also have Joseph Aduntz, which is a tax partner, who is a tax partner at Moore Kingston Smith, and he's got lots of years of experience on advising on a range of private client issues, including income tax, capital gains tax, inheritance tax, and he's also got significant expertise in advising private clients who've got sort of more international aspects to their business as well. So a couple of housekeeping rules. This webinar is for you. We want you to get as much out of it as possible, so please do ask questions. However, please do put the questions in the Q&A function, not the chat function. Put them in the Q&A function. I'll keep track of them and I'll try to weave them in as we go. Any questions that don't get answered, for example, if they're very specific to you, we'll try and pick those up and respond to those individually after the webinar. We are recording this webinar, so please do share with any peers or colleagues who you think might be interested but were unable to make it today. So I think we're going to kick off with a question for you, Joseph. So, I mean, I guess just give us an overview really of what rates and allowances are changing from April 2024.
Okay, right. Thanks, Esther. So just to kick off by saying that there is a spring statement that's scheduled to happen in March. So there is a small chance of there being further changes to, what's coming in for 25-26. Although the government has sort of stated that their intention is to have only one major fiscal event every year, and that's usually in the autumn. So we've obviously had the budget in October last year. So we're not really expecting there to be many changes, but you never know. So we'll wait and see. So in terms of sort of income tax or thresholds and allowances, most of these have been sort of frozen since the 21-22 tax year, and they're sort of due to remain frozen until the 27-28 tax year. So where people have had sort of, increased wages, either through their pay rises, from promotions, or just sort of keeping up with inflation, the effect of having sort of frozen allowances has meant that there are more people paying tax than there otherwise would be if the sort of thresholds and allowances have been uprated. So that's what people typically refer to as fiscal drag. So that's now sort of a feature of the tax system now, and that's going to stay the same for income tax rates and sort of income tax allowances and thresholds until 27, 28. In terms of what's changing from April, so the only thing that's really changing is the employer's national insurance rate. So that's been talked about a lot since the budget announced that in October last year. So the rate's going up to 15% from 13.8%. And that's been, I would say, almost dominating the headlines for a number of months now. And sort of linked to that, there's also going to be a reduction at the level of earnings at which employers' NI starts becoming payable. So it's currently 9,100 and it's going down to 5,000. So if you're somebody who has their own company and historically you sort of paid yourself a salary just at the threshold before, you know, employers' NI starts becoming payable, you just have to be conscious of, you know, this being, I guess, last year, at least for now, that you'll be able to have that sort of slightly higher threshold before employers' NI becomes payable. So if you haven't thought about that already before the end of this tax year, that's something that you should be thinking about for yourself as well as your employees, for those who have businesses. So aside from that, things like the dividend allowance, which is sort of the, you know, the allowance at which you pay 0% tax on dividends, that is still 500, so that isn't changing. And from a capital gains tax perspective, the annual exempt amount is still 3,000. And you might remember as well from the budget in October that capital gains tax rates have increased, and where typically rate increases tend to come in from the next tax year, for that it actually started on budget day on October the 30th last year. So we're sort of set at the sort of capital gains tax rates that were previously announced, and there's no change expected on the main rates for the coming tax year.
What about business assets disposal relief? I guess anyone who's thinking about selling their business might be interested in what's happened to that, Joseph.
Yeah, no, that's correct. Yeah, so for that, the rates are scheduled to change. So business asset disposure relief is a sort of lifetime allowance, which is currently 1 million. So the rate for that is currently 10%, but that's going up to 14% from April. And then a year down the line, it's going up further to 18. So, you know, there's probably around a couple of months left in tax year. So if you're in advanced, you know, negotiations to sell your business, it might be something that features in your negotiations, just making sure that disposal happens while the rates are a bit lower, if possible. So yeah, that's something that will be relevant to a few people potentially on the call, but yeah, but the more general rates have already changed. Hopefully that's all set for now and isn't going to increase anymore from the coming tax year.
Thanks, Joseph. And what about, I mean, what can people do to mitigate the effects of the changing tax rates and the changing allowances? What tools do we have in our box?
Yeah, so one of the, you know, I wouldn't say overlooked, but more popular things to do is sort of pension contributions. So pension contributions are obviously relevant for sort of saving up for a retirement, but they also come with quite valuable tax relief. So that's something that people generally have to be reviewing at this time of the year if they haven't already. So while a lot of employees sort of pay make pension contributions, you know, every month as the year goes on, for other people, for example, self-employed people, they may sort of wait until, you know, they've had earnings during the course of the tax year and then review their position just before the end of the tax year. And it's important to make sure those pension contributions are made in the same tax year, because it's not possible, like it is for certain other tax reliefs, to effectively carry it back to a prior year. So you really do have to match those contributions to the income that you've earned in the same tax year for the relief to be available. and that is probably, I would say, that the most popular and more widely applicable mitigation effects for income tax rates payable, particularly for people who are at those thresholds where their marginal income tax rates are changing. So that's typically around a sort of £100,000 threshold where you have that marginal income tax rate of 6% because of the withdrawal of the personal allowance.
I have a question in, Joseph. So somebody's asked, do we think it's more advantageous to pay less in dividends and more on PAYE for the next tax year?
Yeah. So historically, that question had a clearer answer.
Yeah.
But now with all the sort of, corporation tax increases, which have, come in the last couple of years, as well as sort of the increases to dividend tax rates, there is no simple answer to that. So it really is a case of crunching the numbers to work out what's best.
Yeah.
Because it's not as clear cut as it possibly used to be when corporation tax rates were lower, for example.
Yeah, there's just too many variables, isn't there? And obviously that's an exercise that we can do for clients, but it has to be a very much a tailored, bespoke approach. So what else? I mean, what isn't changing, Joseph? What isn't changing that we still can take advantage of before the end of the tax year?
Yeah. So inheritance tax, maybe not always at the forefront of people's minds, but that's something that you can sort of take advantage of reliefs that are available. For example, there's a £3,000 annual exemption that you get every year. A lot of people don't necessarily think about that, but it's something that, if you're thinking about making gifts out of your savings, you might want to just make sure you're maximizing the use of that relief every year if you're not already. I mean, if you don't manage to, use it, there are other ways you can kind of, mitigate your inheritance tax exposure. For example, you can make gifts out of excess income, as well as the usual 7-year rule that a lot of people probably have heard about, where if you make gifts, you can sort of avoid inheritance tax on that gift if you survive 7 years. The rates on inheritance tax, or the main rate, isn't changing, so that's still 40%. So it's just making sure you're making full use of all the reliefs that are available to refresh every year before the end of the tax year.
Thank you very much. Just having a look at what questions we've had come in. That one I know we're definitely covering later. Somebody's asked, if you haven't made, I mean, maybe this is one for you, David, actually, if you haven't made pension contributions in prior years, can you make those contributions in this year and get the tax benefit in this year, i.e. above the circa 60k annual threshold?
So the simple answer, as long as you have had some form of pension in those tax years, then the answer is yes. So if you've never had any pensions at all, then you can't. But if you've had any kind of pension whatsoever in the 3 tax years prior to the current one, then you do have the ability to carry forward the unused allowances and get tax relief on your 24-25 income.
Thanks, David. And I guess that brings us nicely on to types of investment benefits from tax reliefs.
Okay, so in terms of reducing your tax liability for the current tax year, so for the 24-25 tax year, pensions, which we just talked about, I mean, I think Joseph's right. I mean, you can get income tax relief of up to 60%. Money in the pension can grow tax-free. Once you reach the minimum age for drawing benefits, there are ways that you can draw it very tax efficiently. We still have the 25% allowance for tax-free cash up to the new maximum. And unspent pensions can be passed on to spouses and other loved ones. So I think pensions, I always say this, but I think they deserve a rebrand. I think often they're sort of thought of as a kind of Clark Kent, but really they're Superman when it comes to your financial planning. In terms of other sort of things you can get tax relief, immediate tax relief on in the current tax year, Again, these are much more for those who've already maxed out pension and ISA allowances, and and do have the capacity to accept a little bit more investment risk. But enterprise investment schemes, investments into smaller, unlisted UK companies, you get tax relief of up to 30%. Any profits that you make in future are exempt from capital gains tax. If you've made a capital gain, you can roll forward the point at which you have to pay that liability using the capital gains tax deferral. And they also benefit from business relief exemption from inheritance tax. So the government have announced a new allowance of up to £1 million for the benefit of business relief. But what that means is that shares in an enterprise investment scheme company are exempt from inheritance tax up to £1 million. And beyond that, you get a relief of 50% of the inheritance tax rate. Also, on the kind of, I guess, more sort of private equity type investments, so venture capital trusts, these are listed companies listed on the FTSE All Share. And you get an income tax reduction of up to 30% on an investment into a venture capital trust. There are companies out there that have been running for many years and raise finance annually, and have benefited a lot of investors. Once again, if you sell your shares for a profit, you get an exemption from any capital gains tax you'd otherwise pay on equivalent shares. And also quite attractive is that the dividends are exempt from income tax. So there are other types of investments that have tax benefits, but I can come on to those later.
Yeah, I mean, let's go ahead. And actually, somebody's asked a question about one of them, so let's go on to sort of other sort of more niche, I suppose, types of tax efficient planning investments that you can have.
Well, so I would think of VCTs or venture capital trusts and EIS as kind of, I guess, the more niche ones. But let me talk about some other ones, which I guess are, I'm very happy to go back to either of those two if people have questions. I think the most sort of like, the thing that everyone should be doing if they have, excess savings is to put them into individual savings accounts. Over the years, these have become sort of like, I guess, a little bit more complicated, but also a little bit more flexible as well. So with individual savings accounts now, provided you have invested in a more progressive provider, you can actually take money out of your ISA within a tax year and replace it. You get a £20,000 allowance each year, and you have an exemption from income tax and capital gains tax on any profits that you make, on an arising basis, but also when you cash out or when you draw an income. Investment bonds are written under life insurance policy rules, so they benefit from some of the advantages that you get with an ISA, in that there's no tax on an arising basis on profits that you make. Depending on whether it's on or offshore, investment bond onshore does have a sort of an implied sort of 20% tax liability. Offshore bonds are exempt from tax on an arising basis, but all profits would be taxed if you cash it in. I always could consider these to be a better vehicle for sort of building up wealth when you've maxed out your ISAs and pensions. And this is a future source of income. So one of the things I'd always say to investors is that you need to start building up your wealth in the right vehicles, so that it's going to be very idiosyncratic to you, the right vehicles to use, but they're all plain vanilla stuff: pensions, individual savings accounts, potentially investment bonds, and just general investment accounts. Building up your wealth in those will I think sort of shelter you from a lot of the tax that you would otherwise pay. You can invest in just a straightforward open-ended investment company or a unit trust. These, I think, are going to become much more popular now that we've seen capital gains tax rates both rise, and also the thresholds tapered to very modest levels now. The advantage of an investment fund in that sort of a unit trust or open investment company structure is that anything that happens within the fund itself, so any capital gains, etc., are exempt from tax. So you would only pay capital gains tax when you sell shares in the fund, and you benefit from the dividends. So you will pay tax potentially at lower rates if you're a basic rate taxpayer on the income generated, because it's it's at the dividend tax rates rather than the interest tax rates primarily. What else? Well, I think companies. I mean, so we're a business that advises businesses. I mean, one of the great advantages of having a company is that you're only taxed on profit, not on income. So as individuals, everything that we earn is assessed for income tax, whereas a business, revenue is not the same thing as profit, and you're only taxed on profit within a business. So there's a strong argument for thinking of potentially incorporating and using some of the benefits of a company structure to hold some of your investments.
Okay.
Sorry, Esther, you go ahead.
I was saying we got a question come in on national savings and investment bonds. Somebody said, is interest on a 2-year one, which pays interest at the end, is it all taxable at the end when it's received, or can this be divided between the first and second years?
That is a great question, Esther, and I wish I knew the answer. I think typically with any sort of again, if it's directly held rather than through a company, I think most national savings is individual only. My strong suspicion would be that you're taxed at the end when you actually receive the interest rather than on a rising basis. I mean, that's me thinking out loud, to be absolutely honest. But
Joseph's nodding.
Yeah. I agree, yeah. So interest for individuals is typically taxable when it's paid, even if the period over which it's earned is longer than a year, it'll be taxable when it's actually paid at the end.
So it's not on the accrued basis, which is certainly my feeling as well.
Yeah, consistent with the cash receipt. Can you use up unused ISA allowances from previous years?
Unfortunately not. No, that would be lovely if you could, but no, it's a use it or lose it relief. Now you can obviously, if you're part of a civil partnership, or you're married, or if you have a partner, you can invest into your partner's ISA allowance. So for a couple, the allowance is 40,000 rather than 20,000. So I would always encourage couples to sort of like jointly plan wherever possible.
Is dividend income taken into account when calculating your ability to make pension contributions?
No, it's not. Unfortunately, no. It has to be relevant earnings, which would typically include obviously salaried work, but profits from self-employment. It also doesn't include profits from rental of property. So it's quite specific to effectively earned income. If you'd own a company, or if you're able to, there are more tax efficient ways of making pension contributions through either making just a straightforward employer's contribution on your own behalf, rather than taking the money from your taxed income. And also, I would mention salary exchange, or salary sacrifice, as it's sometimes called, which is a way of reducing your gross salary by the amount that's going to go into the pension, and that creates a saving for both the employer in terms of the national insurance contribution, which is going to be even more meaningful sort of in the new year, when the rate is 15%, but also it will actually sort of give you a reduction on the national insurance that you pay. So on the same salary, making the same pension contribution, if you go through the salary exchange option, you actually end up with more money, well, the same amount in your pension, potentially more if the employer shares their national insurance saving, but also more in your pay packet because you're paying less national insurance. So it's as close to a no-brainer as it's possible to have, to do the salary exchange or bonus exchange to make pension contributions.
Yeah, I think that's something we spend quite a lot of time advising clients on is salary sacrifice. Just hopping back to CGT quickly, somebody's asked what's the date that determines the rate of tax? It always used to be the date of unconditional contract rather than completion. That's getting quite granular, actually. I don't know whether either of you are able to answer that one.
Yeah, it still is when it's an unconditional contract, when that contract is signed rather than completion. That is the general rule.
Lovely, thanks, Joseph. And then sticking with you, Joseph, I guess just moving on to sort of maybe the sorts of things that married couples or those in a civil partnership can do to maximise tax reliefs and bring their tax liabilities down.
Yeah, so I mean, one of the most, I guess, common things to do is to think about whether or not sort of assets can be held jointly if they're not already. But even where they're already held jointly, it's kind of, working out if the split of ownership should be 50-50 or a different split. So it can be, anything from 50-50 to 99 and 1%. But the important thing just to be aware of is that where you are a married couple or in a civil partnership, even if the ownership is varied to anything other than 50-50 split, the default position is still that the income is taxable 50-50 unless you actually submit a form to HMRC to give effect to different split of ownership that you have. So that's something that you should always be thinking about in terms of sort of assets you own jointly, whether or not it is tax efficient to own them jointly, because you might have one sort of, half of the couple who's got significant earned income and is already paying tax at sort of the 45% rate, whereas there might be a couple, the other half of the couple who isn't earning quite so much and is able to benefit still from the lower rates, like the 40% or potentially even 20. So if you're able to kind of vary the ownership of assets you own together and ensuring that you submit that form 17, that's what it's called, to HMRC, so that you're actually taxable on the income that relates to the share you actually own, that's something that you should be sort of definitely reviewing each year. And you can vary those ownership splits year on year because your income levels from your main source of income might change each year. So it's something that you could always review and consider whether it's still appropriate. And similarly for your capital gains, although the annual exempt amount is a lot lower than it used to be at 3,000, it might be more beneficial for, one half of the married couple to realise gains, not only because of the annual exempt amount, but also because of the rates that are sort of payable, because it's all dependent on the level of income as well as the level of gains you realise. So it's just being sort of optimal and taking advantage of one of several benefits, I'm sure, of being married. And yeah, just making sure you're doing those reviews regularly.
Okay, just check the questions. Somebody said, how does that work for an unmarried couple?
Yeah, so unfortunately, if you are unmarried, you don't have the same ability of passing assets in a tax neutral way. You can still vary the split, but the transfers between yourselves won't be tax neutral events. And what I mean by that is if you give an asset away, it's the same for tax purposes as selling the asset. So whereas where you're married, you can transfer assets between each other and it's sort of tax neutral. Effectively, it's not the same when you're unmarried. So while you can, still determine how you want to hold assets between each other, it's not as easy to give assets between yourselves because you always have to think about whether you're triggering the tax liability just by giving an asset to your partner.
Thanks, Joseph. And what about the impacts that sort of rising income levels have had on allowances and release, and how can we sort of mitigate that before the end of the tax year?
Yeah, so I briefly touched on there's quite high marginal rates of income tax. So this can apply for sort of people who are claiming child benefit. It might be something that people are aware of already, but if you claim child benefit and you're what is described as a higher earner, so that threshold is actually, for what a higher earner is actually increased. So it used to be 50,000, but it now starts at 60,000. But what happens is that if you earn have income of more than 60,000, the sort of child benefit that you claim starts to be effectively withdrawn until your income hits 80,000, and then the child benefit that you get paid is effectively completely withdrawn. So where your higher earner in the couple is kind of at that sort of higher level of income, and it's sort of possible for you to, reduce your income, for example, as I mentioned briefly, salary sacrifice. So that's something that you can consider doing before the tax year ends, in terms of making sure you're not losing out on your child benefit, as well as still, having the benefit of that money, obviously at a different time. If it's something like salary sacrifice, pension contributions, you're increasing the sort of pension pot that you can later rely on in retirement. So yeah, typically salary sacrifice is the sort of thing that you should be looking at doing to reduce your income level, just so that you're not being hit by the child benefit withdrawal. A similar point arises, as I briefly mentioned earlier, when your income hits 100,000, your tax-free personal allowance begins to be withdrawn as well. So between 100,000 and around 125,000, you have a fairly high marginal rate of tax of 60% for each pound that you earn over that. So again, you can consider salary sacrifice as a way of bringing down your income down if you're employed. If you're not employed, you can do things like make pension contributions, as we talked about. So that can also reduce the sort of, the rate of tax that you're paying at those sort of levels of income. We've talked about pension contributions already, and there is a pensions allowance of 60,000. And again, that begins to be tapered down to the minimum level, which is now 10,000. You do have to have a reasonably high level of income before that becomes relevant, of around 260,000. But if you've, not reviewed your level of pension contribution so far in the year, you might want to have a look at that to make sure that you're not going to be hit by the tapering of your pension annual allowance. Because what happens if you've made excess pension contributions is that you effectively have to pay a tax charge in the tax year as a way of clawing back the excess contributions you've made. So it's definitely important, if you're sort of a reasonably high earner, to review what pension contributions you've made in the year, because things like bonuses, if you're employed, can quite easily tip you into these higher levels. And a lot of people often don't realise this has happened until after the tax years.
Thank you, Joseph. We've got quite a lot of questions outstanding about inheritance tax, but just to let you all know, I'll hopefully we will answer them, but I thought I'd save them to the end because we're going to be talking about inheritance tax. So I guess back over to you, David. So obviously the Chancellor's announced that pensions will become subject to inheritance tax from April 2027, which has been hugely unpopular. I mean, what are the implications for pension savings, and are pensions still as valuable?
Yeah, I'm talking about this a lot with my clients and with my colleagues as well. So I think that, the first thing to say is that the changes don't come into effect until April 2027. And I'm counselling all of my clients, and I think it's a very important message to get across. Be very careful about any planning that you do now, because you could potentially put yourself in a worse position than if you wait until April 2027. But now is absolutely the time to start thinking about your longer term planning. The other sort of thing I want to say is that the final rules are still being drafted. Now, there was a consultation which ended at the end of last month, and the pensions industry has lobbied quite heavily in the current drafting of the rules, just pointing out some of the unintended consequences. So I don't think we're expecting to see the final rules until the end of this year. So I think in the absence of any clarity, we have to be very mindful that we need to plan. We need to plan ahead, but we can defer the point at which we actually implement those plans until the rules are absolutely cast iron and clear. I suppose the other thing I'd sort of say is that just going back a few years, unspent pensions always were subject to some kind of tax. From 2015 onwards, they were completely taken out of the tax net. And I think we kind of got used to the pensions being a great store of wealth for the next generation. But certainly in my career, unspent pensions were taxed at up to 55%. So 40% inheritance tax is very unwelcome. And I think the biggest issue there, frankly, from a how the government have positioned it is by calling it inheritance tax. I think that's probably the most emotionally charged tax out there. So I think a better advised government would probably delink it from inheritance tax and potentially tax unspent pensions, but maybe in a way that was easier to implement and less emotionally charged. But that's I suppose a bit of politics. I suppose the good news is that tax relief on pensions hasn't been touched. There's still this fantastic opportunity for the sort of tax alpha, getting up to 60% tax relief, on the way in, and potentially only paying 15% tax effectively on the way out. So that sort of tax alpha is still there. Growth is still tax exempt, so you can build your pension pot without any tax on a rising basis. So you've got that huge advantage. Tax-free cash allowance hasn't been touched. A lot of my clients have been very worried about that historically for the last 20 years, but for the last 20 years, I've counselled them not to worry about it, and I've been right, I think, so far to date. Benefits still tax-free if passed on under age 75, so particularly to a spouse. So no inheritance tax on spousal transfers, and up to age 75, you can have the whole pot tax-free. I guess the things that are coming from it are potentially annuities, and maybe even temporary annuities becoming more attractive. And I think some of the planning strategies that we're thinking of post 2027, when the rules there is for large pension pots, you can create an income, and yes, you'll pay some tax on the income, but you can then have that excess income, which Joseph alluded to, which is immediately exempt from inheritance tax. So there's a potential sort of planning available for people to start drawing an income from a pension and then gifting that income, and the gift being immediately exempt from inheritance tax. So I think every time the rules change, myself, my colleagues, and I think in professional services firms, all around the country, we start thinking, okay, so what's the challenge that our clients are going to face, and more importantly, how do we sort of start solving those challenges, and how do we use the rules so that our clients are put in the best possible position. So it's I guess a bit of a golden age for for people wanting advice, that as things become more complicated and nuanced, and as circumstances are such a high, your personal circumstances are such a sort of unique thing, the advice that's going to be right for you is really going to be very sort of based on that, and about us understanding how the rules are going to impact you, and how we can help you and your family sort of to end up in the best possible place from a tax point of view, and also from a long-term planning point of view. I mean, reducing taxes is hugely important to that, but you really should be careful about letting the tax tail wag the investment dog, and so on. So think about what's important to you, and then we can help, I guess, sort of like with that. Couple of just quite quick practical points on that, really. So in terms of what you can do, so I think you definitely start thinking about your planning. come and talk to us and our colleagues about, about yourself and, your challenges and what's keeping you up at night and where you want to get to. And we can certainly help with that. Ensure your wills are up to date. So anything to do with, estate planning and how you want your legacy to be structured. Your will is the first place to start. Our colleagues at Moore SGD Law can help with wills, and they also have a family law team as well. Nominations of beneficiaries for pension pots. If you've got a pension plan or several pension plans, make sure that you've revisited the nomination of beneficiaries or the expression of wishes, which is the bit of paper that tells the pension company what you would like to happen to your pension benefits if you don't spend them all during your lifetime. Obviously, talk to your advisor. We're here to help. And finally, any long-term planning. If you're running a business, you'll have a 5-year plan. And I think that every individual should have a 5 or a 10-year plan, or a plan for their their retirement, or for when they want to become financially independent. And again, we can sort of help with that.
Thanks, David. I think we've got time for a couple of quick questions. Implications with respect to IHT if you've got commercial properties in your pension.
This, I think, is one of the things that is going to be finalised. My understanding is that it's the pension pot itself that gets taxed. So I don't think what the underlying are there's much of a look through. Actually, a related question is to do with investments which are exempt from inheritance tax under the business relief rules. So small unlisted companies, or or anything that would qualify for the business relief. Our understanding is that the size of the pension pot, not the makeup of the assets, is what will be assessed. But the rules aren't clear, and also the rules haven't been determined. So again, I would counsel anyone from making any sort of long-lasting decisions until the rules have been clarified.
And then we're going to end on a question about crypto. So they quite rightly point out that a lot of people will have made money on crypto assets, though they have remained anonymous. What tax does one pay on crypto asset gains and income? When does the tax arise? Is there any way of sheltering the income and gains? And can you trade crypto through ISAs or in a pension? So a bit of something for both of you there.
Absolutely. The second bit is you can't hold them in ISAs or a pension. So that's pretty clear. So if there's any tax structuring to be done, Joseph, I think you're a better place to.
Yeah, I mean, so first of all, yeah, crypto is something that has increased in popularity over the years, and also the treatment of crypto has, or should I say, HMRC have changed their mind over the years about how to treat it. But effectively, if you're, a casual crypto investor, and you're realizing gains from trading crypto because you're buying crypto that then goes up in value, so those gains are taxable, and they're usually taxable as capital gains rather than income. There are probably limited scenarios where crypto gains can be taxed as income, but you'd have to be making some seriously large number of transactions, typically with a degree of sophistication that the casual, investor wouldn't be able to do. So typically there are gains that you have to declare if you're, trading your crypto. How can you structure it? Well, it's similar to any other personal investments. You can either do it personally, or you could do it, as you can't put it in an ISA, as Dave has confirmed, you might think about whether or not you want to have it in a company. So if you're not needing to spend, the money that you make from the crypto, and you want it to kind of be reinvested in, so a company can be a good place to start, because, most people understand how companies work, and the rate of corporation tax is lower than, personal tax rates, although because it's capital gains, it's not quite a simple answer as corporate versus personal, because corporate rates are almost equivalent to personal rates now for capital gains. So unless you're going to be somebody who's doing it as a sophisticated person where there's a chance it could be income, then you might be thinking about a corporate as a way of kind of reducing the rate of tax payable. So I guess the simple answer is taxable rates variable depending on if you're doing it personally or in a company. If you're doing it personally, usually capital gains in very limited circumstances could be income.
Sorry, I muted myself. My dogs are going a bit mental because somebody knocked at the door. Yeah, I think the answer is come and seek advice when it comes to crypto, because it's still relatively new territory. So you probably need some bespoke advice around that. Thank you very much. We have definitely got up overrun 3 minutes. That's very unlike me. So thank you all very much for attending. Hopefully you've all got some really good takeaway points from today. We'll share details of how any of you can set up personal appointments with us if you want to speak to either David or Joseph. Don't forget it was being recorded. Please do share it with peers or colleagues who couldn't make it, and also please do fill out the feedback form. It's really short, but it's really useful in helping us to shape future webinars. That's it. Enjoy the rest of your day. Thank you very much, and thanks to David and Joseph. Thank you.
Thanks.